Okay, I need you to stop what you're doing. Turn off your phone notifications, close every other tab. Because what I'm about to tell you didn't make it to the front page of any newspaper, wasn't trending on social media, and most people still don't understand what just happened. In 72 hours, from Thursday, January 30th to Sunday, February 1st, 2026, approximately $6 trillion vanished from global markets. Not over weeks, not over months. In 3 days. This wasn't a crash, it was a liquidation order. To put that in perspective, that's roughly 3 times the entire market capitalization of Bitcoin at its peak. That's more than the GDP of Japan. That's the kind of wealth destruction that usually requires a world war or a complete financial system collapse. Except this time, it happened over a single weekend while most of America was planning their Sunday routines. This is the story of Black Week. The 72 hours that proved every safe haven asset could break at the same time. Gold, silver, Bitcoin, bonds, everything collapsed together. And the trigger? One announcement from President Trump that changed everything. Here's what you need to understand before we go deeper. Exact figures vary depending on methodology. Some analysts calculate losses at 6 trillion, others at 10 or even 15 when you include extended market cap destruction. But every credible estimate lands in the same place. Trillions, not billions. Because what happened wasn't really about Trump's Fed pick. He wasn't the cause. He was the match in a room already filled with gas. Let me take you back to Friday morning, January 30th, 2026. President Donald Trump announced his pick for the next Federal Reserve Chairman to replace Jerome Powell, Kevin Warsh, a former Fed governor from 2006 to 2011, a Wall Street veteran from Morgan Stanley, an inflation hawk with a legendary reputation for monetary discipline and tight policy. The market's reaction was immediate and catastrophic. Within minutes, the US dollar surged like it hadn't in years. Treasury yields spiked across the entire curve. And every asset that had rallied on the debasement trade, the bet that endless money printing would destroy fiat currency, went into absolute free fall. Gold, which had hit an all-time high of $5,595 per ounce just hours earlier on Thursday night, collapsed by 11% in a single trading day, from $5,595 to $4,745. A drop so violent that traders who had spent 4 decades in precious metals markets said they had never seen anything remotely like it. And this was just day 1 of the 72-hour massacre. But gold was just the opening act. Silver was the main event. The white metal, which had been trading at $121.62 per ounce on Thursday morning, a price not seen since the legendary Hunt Brothers silver squeeze of 1980, didn't just fall, it disintegrated. By Friday afternoon, silver had crashed to $78.29, a 36% single-day collapse, the worst percentage drop in over 4 decades. Here's the part nobody wants to talk about. Polish analyst Maksymilian Bączkowski from Komprek spent the weekend analyzing trading patterns and discovered something that should terrify anyone who still believes in free markets. JP Morgan Chase closed approximately $10 billion in silver short positions at the exact market bottom. Not approximately at the bottom, not near the bottom. At precisely $78.29, the exact low tick of the entire 3-day collapse. The mathematical probability of that happening by pure chance is essentially 0. Bączkowski didn't mince words. He called it a brutal rescue operation of the system rather than a natural correction. And when the CME, the Chicago Mercantile Exchange, suddenly hiked margin requirements on silver futures in the middle of Friday's crash, forcing leveraged traders to either post massive additional capital immediately or face forced liquidation, it looked less like responsible risk management and more like coordinated intervention to accelerate the washout. The timing was too perfect, the execution too precise, the damage too concentrated. But here's where the 72 hours get even more catastrophic, because the carnage didn't stop Friday. It accelerated through the weekend. Saturday and Sunday, when most traditional markets are closed but crypto trades around the clock, became a bloodbath for digital assets. Bitcoin was supposed to be different. The digital gold, the decentralized hedge against exactly this kind of centralized manipulation. How did it perform during the 72-hour stress test? It collapsed too. Bitcoin, which had been trading around $90,000 on Tuesday, January 28th, crashed through critical support levels on Thursday. By Thursday afternoon, January 29th, Bitcoin had plunged to $83,383, its lowest level since November. The selling accelerated into Thursday evening, with Bitcoin falling to $81,000 as more than $777 million in leveraged crypto positions were liquidated in a single hour. But the weekend brought even more devastation. On Saturday, January 31st, Bitcoin collapsed below $80,000 for the first time since April 2025. The price continued falling through the thin weekend liquidity, reaching a terrifying low of $75,644 on Saturday night. More than $500 million in additional leveraged long positions were liquidated across Saturday and Sunday alone. Hundreds of thousands of traders wiped out. The exact same liquidation cascade pattern as gold and silver, just extended over the entire weekend to hit crypto traders when traditional market oversight was offline and they were most vulnerable. And suddenly, the narrative that Bitcoin was digital gold looked less like prophecy and more like marketing. Because when push came to shove, when real fear hit the markets, Bitcoin didn't act like gold. It acted like a leveraged tech stock, a risk asset that gets sold first when liquidity gets tight and margin calls hit. This is where the story breaks. The synchronized collapse across 72 hours of all these supposedly uncorrelated assets tells you something profound about how modern markets actually work. They're not independent ecosystems, responding to different fundamental forces. They're all connected by the same underlying fragile structure: excessive leverage, thin liquidity, and total dependence on the US dollar as the global reserve currency. When Trump announced Warsh's nomination Friday morning, the market instantly repriced the entire global monetary regime for the next 4 years. But Warsh didn't create the fragility, he simply revealed it. Markets had spent over 2 years building the most crowded trade in modern financial history. Everyone betting the same direction. Everyone using leverage to amplify returns. Everyone absolutely convinced that central banks would print money forever to finance government deficits. And when everyone is positioned the same way, when everyone is leveraged the same way, the exit door becomes microscopically small. When Trump made his announcement, everyone tried to exit simultaneously. The result over the next 72 hours wasn't a correction, it was a stampede. Warsh is known for 3 things that terrified the debasement trade crowd. 1, he's a hardcore inflation hawk who publicly believes interest rates should be higher, not lower, even if it causes short-term economic pain. 2, he wants to actively shrink the Fed's balance sheet back toward pre-COVID levels, not expand it further. 3, he values institutional credibility and long-term monetary discipline over short-term political accommodation or market support. In other words, everything that had fueled the parabolic rally in gold, silver, and Bitcoin over the previous 12 months, the expectation of endless money printing, accelerating currency debasement, and permanent Fed accommodation, just got directly challenged by a single personnel announcement. The dollar surged because a stronger, more disciplined Fed under Warsh means a structurally stronger currency over his 4-year term. Treasury yields spiked because markets started immediately pricing in higher rates for longer and slower balance sheet expansion. And every single asset that had rallied on the assumption that fiat currency would be debased to worthlessness suddenly faced an existential question: what if that thesis is wrong, or at least premature? Now let's talk about the scale of destruction across the full 72 hours. By most market capitalization estimates, approximately $6 trillion in value evaporated from Thursday's close through Sunday's crypto bottom. Gold lost an estimated $4 trillion in total market capitalization from Thursday's peak to Friday's close. Silver shed roughly $1.4 trillion in market cap in the same 24-hour window. The S&P 500 dropped around $780 billion in Friday's session alone. The Nasdaq erased approximately $750 billion. And cryptocurrencies lost over $100 billion from Thursday through Sunday's washout, with Bitcoin alone dropping from $90,000 to $75,600, a decline of over $14,000, representing approximately 15% of its market capitalization. Add it all up across the full 72-hour window, you get approximately $6 trillion gone in 3 days. And this is the detail that changes everything. For over 2 years, institutional investors, hedge funds, family offices, and retail traders had been piling into hard assets with near religious conviction. Gold, silver, Bitcoin, real estate, commodities, literally anything that couldn't be printed by central banks or debased by government policy. The intellectual logic was simple and compelling. Governments around the world were running record peacetime deficits. The U.S. federal deficit was over $2 trillion annually. Central banks had printed trillions during COVID and never really stopped. Inflation had spiked to 40-year highs. Geopolitical tensions were rising. Therefore, by pure logical deduction, fiat currency had to lose value over time, and hard assets would protect purchasing power. It was a beautiful thesis. It was intellectually rigorous. It attracted literally trillions of dollars in capital. And it worked brilliantly, delivering massive returns for 2 years until Thursday, January 30th, at approximately 9:45 a.m. Eastern Time, when it all fell apart in 72 catastrophic hours. Because there's an iron law about crowded trades that most people forget until it's too late. When everyone believes the same thing, when everyone is positioned the same direction, when everyone has used borrowed money and leverage to amplify their bets, the exit door doesn't just get small, it effectively disappears. And when Trump announced Warsh's nomination Friday morning, literally everyone with leveraged long positions and hard assets tried to go through that non-existent door at exactly the same time. The result wasn't an orderly correction, it was a stampede. Once leverage reaches this level, the outcome is no longer optional. The technical term for what unfolded is a multi-day liquidation cascade. Here's the mechanical sequence. Thursday night, after speculation about Warsh began circulating, initial algorithmic selling and after-hours futures markets pushes prices down. Friday morning, when Trump makes the official announcement and physical metals markets open, those lower prices immediately trigger stop-loss orders, creating a second wave of forced selling. That additional selling triggers margin calls on leveraged positions, forcing traders to either post massive additional collateral immediately or face automatic liquidation. Most can't post the collateral fast enough, so forced selling accelerates dramatically as exchanges systematically liquidate under-margined accounts. The forced selling breaks through critical technical support levels that algorithmic trading systems monitor continuously. When those levels break on heavy volume, it triggers a third wave of systematic selling by computer programs, and the cycle feeds on itself, building momentum, accelerating, until either you run out of leveraged positions to liquidate, or buyers step in with enough capital to absorb the selling pressure. Friday's precious metals crash suggests we ran out of leveraged longs by end of day. Every overextended speculator had been wiped out, every margin account liquidated. The selling finally stopped not because conditions improved, but because there was nobody left to sell. But here's the critical insight about the 72-hour window. The crypto markets don't close. They trade continuously. So while precious metals found a temporary bottom Friday evening, the liquidation cascade simply migrated to cryptocurrency markets and continued demolishing leveraged positions throughout the entire weekend. Saturday and Sunday became a massacre, Bitcoin plunging from the low 80s to 75,600. Ethereum collapsing. Over 500 million in additional liquidations, hundreds of thousands of accounts zeroed out. And by late Sunday, the markets had finally stabilized, not because confidence returned, but simply because the most over-leveraged traders had been completely wiped out. There was literally nobody left to sell. The 72-hour liquidation order had been executed in full. Here's what nobody's saying out loud. What we can say with absolute certainty is this. The precious metals rally had become parabolic and unsustainable. Silver had literally gone from around $70 to $121 in less than 30 days. That's a 72% gain in 1 month. Gold had surged from around $4,000 to $5,595 in a similar time frame. Bitcoin had climbed from the mid-80s to over $126,000 in October before correcting back to the $90,000 range. These weren't normal market moves. They were speculative manias driven by FOMO, algorithms, and leveraged hedge funds. When markets get that extended, that overbought, that euphoric, they become extraordinarily fragile. Trump's announcement of Warsh wasn't a small catalyst. It was a thermonuclear device dropped directly onto the most crowded trade in global markets. But the kindling had been stacked for weeks by reckless speculation and excessive leverage. And the 72-hour conflagration that followed burned out every overextended position across every hard asset class simultaneously. Bitcoin's performance during Black Week is particularly revealing. The crypto community has spent a decade promoting Bitcoin as digital gold, a decentralized hedge against currency debasement, a safe haven asset. But when real monetary policy fear hit the markets over 72 hours, Bitcoin behaved exactly like a high beta leveraged technology stock. It fell harder in percentage terms than gold. It suffered more severe weekend liquidations. Why? Because Bitcoin isn't actually held as a safe haven by most investors. It's held as a speculative growth asset. When fear hits, when margin calls come, Bitcoin is often one of the first assets that gets sold. Not because investors don't believe in the long-term thesis, but because it trades 24/7, has liquidity, and can be instantly converted to cash to meet margin calls. This is brutal truth. Until Bitcoin can hold its value during a real risk-off monetary tightening event, it's not digital gold, it's digital Nasdaq. This is the moment that redefines everything. Black Week isn't just history, it's a structural warning about the fragility of modern markets and the catastrophic danger of consensus trades built on leverage. The entire bull market in hard assets was built on one assumption. Central banks would be forced to keep printing money indefinitely. That assumption just got challenged by Trump's appointment of Kevin Warsh. If Warsh follows through on his hawkish preferences, if he shrinks the Fed's balance sheet, if he keeps real interest rates positive, then the macro environment changes fundamentally. And paradoxically, the assets that were supposed to protect you from central bank recklessness become the assets that suffer most when central banks demonstrate discipline. This is the intellectual paradox. The trade only works if central banks continue to be reckless. The moment they show restraint, the trade falls apart. And that's precisely what happened over 72 hours. Markets had spent 2 years pricing in perpetual currency debasement. Warsh's nomination suggested that might pause, and trillions in leveraged positioning had to be violently unwound. But here's what most people are missing. It's not over. The leveraged positions have been flushed. But the fundamental structural questions haven't been answered. U.S. government debt is still $38 trillion and growing. Deficits are still massive. Geopolitical tensions are still rising. The long-term case for hard assets hasn't fundamentally changed. What changed is the time frame. Markets priced in immediate currency collapse. That's not happening under Warsh, at least not yet. But does Warsh's appointment solve $38 trillion in debt? No. It suggests the Fed might not immediately monetize everything. The crisis might be delayed, not prevented. And that creates an opportunity for patient capital with zero leverage. If you believe the fundamental case remains intact, Black Week just gave you a discount. Gold down roughly 20%. Silver down 40%. Bitcoin down from 90,000 to 75,000. For long-term investors who missed the rally, this weekend gave them a second chance. But here's the crucial distinction. Long-term investors with zero leverage can wait through volatility. They can accumulate on weakness. They can hold for years. They never face margin calls. Leverage traders cannot. And that's the core lesson of Black Week. Markets will liquidate leveraged positions before moving where fundamentals suggest. If you're using leverage on a long-term thesis, you'll get liquidated on short-term volatility even if you're ultimately right. The market takes your capital first, proves you correct later, because leverage is how markets transfer wealth from impatient hands to patient ones. And Friday through Sunday was one of the most efficient wealth transfers in history. $6 trillion over 72 hours. From everyone using maximum leverage to institutional players who closed shorts at the bottom. So what happens next? 3 scenarios. First, stabilization and range-bound trading. Gold finds support around 4,500. Silver holds above 75 to 80. Bitcoin consolidates between 75 and 85,000. We trade sideways for months. Highest probability. Second, the flush continues deeper. Support breaks. Gold tests 4,000. Silver drops towards 60. Bitcoin revisits the 60s. Requires more hawkish catalysts. Third, sharp V-shaped reversal. Massive buying from sovereign funds. Sharp rally requires macro narrative shift. My capital is positioned for scenario 1, prepared for scenario 2. Because in markets this fragile, anything remains possible. What I know with certainty, the game has changed. The assumption that hard assets only go up is broken. The belief that Bitcoin is digital gold has been tested and failed. The idea that central banks always print has been challenged. And the fragility of over-leveraged trades has been exposed. Black Week will be studied for decades. But for those living through it, it's not academic. It's real capital, real losses, real consequences. The question is whether you learned the lesson. Stay safe, stay liquid, stay unleveraged, and remember that markets will always shake out the weak hands before rewarding the patient ones. That's the lesson of 72 hours.